Welcome back to the deep dive. Today, we are grabbing what is probably the most essential tool in any investor's toolbox valuation, and we're really going to hold it up to the light.
Yeah, because every single investment decision, every thought about whether to buy, sell, or hold, it all comes back to this one concept.
Exactly. And yet, the primary framework everyone learns, the one used all across professional finance, the discounted cash flow model, or DCF, is, let's be honest, notoriously sensitive. It's incredibly fragile.
And it relies, frankly, far too much on guesswork. And that fragility is exactly why this deep dive is so crucial today.
Right.
We're going way beyond that introductory question of what do I think this company is worth?
We're pushing into something more profound.
We are. We're exploring the question that really matters if you're operating in the public markets. What does the market think this company is worth? That little shift in perspective, that's where all the real insight is born.
And that's what makes this so fascinating. You, our listener, share some absolutely fantastic sources comparing the traditional DCF with its powerful conceptual mirror image, the reverse DCF. So our mission today is to unpack the mechanics of both, for sure, but I think more importantly, to really understand their fundamental philosophical split.
Because the way they approach the future is just diametrically opposed.
It is. And we're going to show how that reverse DCF can act as this crucial reality check, forcing a kind of skepticism, especially when, market narratives get really hot and euphoria starts to take over.
The core distinction is just a beautiful inversion, really. The traditional DCF, it tries to define this absolute sort of objective intrinsic value.
Right, the true value.
But to do that, it requires the analyst to feed it these highly subjective, totally unprovable forecasts about the distant future.
And the reverse DCF just flips that entire workflow on its head.
Completely. It starts with the one thing we actually know, the objective market price. That's a fact. And it works backward from there.
So its output isn't a price target?
No. Its output is a precise, quantified statement of the market's collective expectation. It tells you exactly what has to happen for today's price to make sense.
It really is the difference between an analyst trying to be, an infallible fortune teller.
Yeah.
And an analyst stepping into the role of a skeptical, analytically rigorous critic. And that shift, that changes the entire nature of the valuation debate.
It absolutely does.
So let's start with the classic model. The traditional DCF. It's the gold standard. It's the bedrock of modern finance, the thing every analyst, cuts their teeth on.
It is.
We have to understand its philosophical foundation first, this mandate to separate price from value.
And that mandate is, it's ambitious. It's steeped in history, and it's fundamentally idealistic. The goal is to establish an asset's intrinsic value, a stable measurement that comes purely from its fundamentals.
And this is explicitly separate from its price.
Exactly. The price is volatile, temporary. It's what the stock happens to be trading for today. The value is supposed to be something more permanent. And this idea goes back, over a century. It was solidified by economists like Irving Fisher and really cemented by John Burr Williams in his 1938 classic, The Theory of Investment Value.
And the core theory is so simple and elegant that the true intrinsic value of any asset, doesn't matter if it's a bond, a house, or a share of stock, is just the present value of all the future cash it's ever going to generate.
Discounted back at an appropriate rate. Precisely. And what this means is that the traditional DCF is what we call an absolute valuation method.
Okay, so what does absolute mean in this context?
It means it stands apart from relative methods, like comparing the price-to-earnings ratios of company A to company B.
So you're not looking at what the neighbors are doing.
Exactly. The DCF is supposed to look purely inward. It relies only on that specific company's financial projections, its cash flows, and its own unique risk profile.
But here's the magnificent paradox, right?
Yeah.
This is the thing that makes the traditional DCF so unstable in practice. And it's why our sources call it an untestable hypothesis. The goal is this objective, fundamental, absolute value. But the execution relies entirely on these highly subjective, inherently unprovable forecasts about the future.
That's the vulnerability. It's baked right into the math. I think about it. If I forecast revenue growth at 6% for the next 5 years, and you forecast it at 5%...
We're going to get two wildly different valuations.
Wildly different. And neither of us can prove our input is correct until, 2029? The DCF output, that final $100 per share, it's not an objective truth.
It's just a number that spits out of a formula.
It's merely the mechanical consequence of an analyst's opinions.
Yeah.
And this transforms the output into what the sources perfectly describe as a contest of persuasion.
And crucially, this isn't just some academic inconvenience. This fragility gets actively exploited in the market, doesn't it? Especially in these high-stakes corporate deals.
Oh, absolutely. Think about an investment bank advising a client on an acquisition. If that bank is, let's say, fee-seeking, they are highly motivated to justify the deal price.
They want the deal to happen.
They want the deal to happen. So they can use this traditional DCF framework, which looks so objective and rigorous on the surface, and just plug in intentionally optimistic forecasts for margins or growth.
And poof, they get a valuation that conveniently validates a high purchase price.
Exactly. The model, which was designed for discovery, becomes a tool for justification. The buyer thinks they're acting on rigorous analysis, when in reality they're acting on some very optimistic, very subjective projections that are hidden deep inside a complex spreadsheet.
So to really understand the extent of this fragility, we have to look closely at the three pillars of the model. Pillar 1 is forecasting free cash flow, or FCF. That's the numerator in our equation.
Right, the FCF projection. This is the grinding, detailed work of the model. The analyst projects the company's performance over what's called an explicit period, usually 5 or 10 years.
And our sources are right to emphasize that anything beyond a decade.
Oh, and even a decade is often heroic.
Right, it's just considered a real guessing game.
Mm-hmm.
It's so hard to predict things like technological disruption, regulatory shifts, competitive dynamics that far out.
It's pure guesswork at that point.
And we have to be specific about the type of cash flow we're talking about, right? There are two main measures.
Exactly. First, you have free cash flow to the firm, or FCFF. That's the cash available to all the capital providers, so both the debt holders and the equity shareholders.
And for that, you use the WACC, the weighted average cost of capital, to discount it.
You do. Then there's free cash flow to equity, or FCFE. That's the cash available only to the equity holders, and for that you'd use the cost of equity. But, regardless of which flavor you use, you're still projecting revenues, operating costs, capital expenditures, working capital needs.
All based on assumptions that may or may not hold true 5, 7, 10 years from now. Okay, so that brings us to Pillar 2, determining the discount rate, or R. This is the denominator, and it does a couple of vital jobs.
It does. First, it accounts for the time value of money, the simple idea that $1 today is worth more than $1 tomorrow. But more importantly, it accounts for the risk inherent in those future cash flows.
So the riskier the company, the higher the discount rate.
The riskier the flows, the higher the rate. Yes. And this is where the model is just lethally sensitive, because those cash flows far in the future are being divided by this denominator raised to a power, year after year.
So tiny changes in that WACC assumption
Can wildly change the final present value output. And our sources highlight a really critical, though often overlooked, methodological error here: the use of a static WACC.
Explain that static WACC error in more detail. I think a lot of people, especially if they're new to valuation, just assume that risk rate is a constant number.
And that is the assumption. But that's the mechanical flaw. Analysts will typically apply one single WACC, say 10%, across every single future year, from year 1 all the way out to year 50 and beyond.
But that doesn't make intuitive sense.
It doesn't. Think about the reality of a business. A small, high-growth startup that's battling for market share is incredibly risky. Its cost of capital should be very high.
Of course.
But 10 years later, if that company has achieved scale, it has reliable cash flows, it's paid down its debt, its risk profile has dramatically decreased, it's a much safer company.
So if the risk profile naturally goes down over time, but the analyst keeps using that high static WACC from the early days, what's happening mechanically to the valuation?
You're artificially penalizing the cash flows in those later, safer years. You're discounting the stable cash flows of a mature, de-risked company using the super high risk rate of its startup phase.
So the model systematically understates the value.
It systematically understates the value of any company that's expected to mature successfully, particularly those with long asset lives or predictable cash flows way out in the future, like a utility or certain infrastructure plays. The analyst risks creating a self-fulfilling prophecy of undervaluation just by using a methodologically flawed static rate.
That brings us to the most critical and yet the most uncertain component of all. Pillar 3, the terminal value, or TV. This single number captures the value of all cash flows beyond that explicit forecast period.
So from year 11 to infinity.
To perpetuity. It's mind-boggling.
Is the model's Achilles heel. Because of the mathematics of discounting, the terminal value often makes up 75% or even more of the total calculated intrinsic value.
Stop there. Let that sink in.
Yeah.
The most rigorous, detailed, defensible part of your model, that 5 to 10 year forecast you slaved over, is often completely overwhelmed by a single, high-sensitivity calculation that represents an infinite future.
75%. It's staggering. It means your entire valuation basically hinges on your long-term assumptions about forever.
So how do we even calculate that?
Well, there are two main ways. First is the perpetuity growth model, often called the Gordon growth model. This just assumes a constant, stable growth rate, G, forever.
And the math requires that your discount rate, R, has to be higher than your growth rate, G.
It does, and this calculation is unbelievably sensitive. If you assume a G of, say, 2.0%, but your competitor assumes 2.5%, they might come up with a valuation that's 20–30% higher than yours.
Even if every other variable is identical.
Identical. You end up in these debates over perpetual growth rates that are separated by mere half percentages. It's kind of absurd.
And the second method for terminal value is the exit multiple approach.
Right. This method tries to calculate the value by assuming the company is sold at the end of your forecast period. You do that by applying a market multiple like enterprise value to EBITDA that you get from looking at comparable companies at that future date.
Ah, and this is where the model gets logically circular.
Totally circular.
Because the whole point of the DCF was that it was supposed to be absolute based purely on the company's internal fundamentals. But now, to finish the most important part of the calculation, we have to look outside at relative valuation multiples of other companies.
Exactly. You're forced to rely on current market sentiment, which is reflected in those comparable multiples, to conclude your supposedly objective fundamental analysis. It's an unavoidable compromise, and it just shows how difficult it is for the traditional DCF to ever truly achieve the philosophical purity it's aiming for.
So we arrive at the collective conclusion. Garbage in, garbage out. GI go.
Classic GI go.
The traditional DCF is presented as this objective, scientific, mechanical tool, but its results are completely at the mercy of subjective forecasting, especially when you consider that 75% TV component.
It's a classic case of confusing precision with accuracy. The mathematical output might be precise, down to the penny, but the underlying assumptions make the accuracy of that number highly, highly dubious.
The sources widely agree that forecasting performance 10 or 20 years into the future involves, and I'm quoting here, a healthy dose of guesswork.
A very healthy dose. And because the outcome is so sensitive to that WACC and that terminal growth rate, the model is just so easily manipulated, either consciously or subconsciously, to validate whatever answer you wanted in the first place.
And that leads to its core weakness in public market investing. The final output of a traditional DCF is just a simple decision, right?
Yeah.
If my calculated intrinsic value is greater than the current price, I buy. If it's less, I sell.
Simple binary choice.
But if my intrinsic value is just the mathematical result of my own personal, unprovable opinion about perpetual growth, how strong is that buy or sell signal, really?
It's often incredibly weak, because the analyst is forced into the role of being a poor forecaster. They're defending their own prediction against the collective wisdom or folly of the entire market. And unless the mispricing is just glaringly obvious, their subjective inputs are immediately going to be challenged by anyone who happens to disagree with their final price target.
So the model is perfect when you have to create a value from scratch.
Right, like for a private company where there is no price, you need that anchor. But it struggles tremendously when it has to confront an existing market price.
Okay, that necessary critique of garbage in, garbage out brings us directly to the conceptual solution. The analytic conversion, the reverse DCF. This framework was developed as a direct intellectual response to the traditional DCF's forecasting problem.
The philosophical shift here is everything. It's a complete 180.
How so?
Traditional valuation starts with the assumption that the market is wrong and the analyst is right. The analyst tries to impose their subjective view onto the unknown future. The reverse DCF flips that entirely.
It says the market is what it is.
It says the price is the price. The market has already spoken. My job is not to predict the future, but to understand what future the collective wisdom, or, perhaps the collective mania of the market has already priced in.
So instead of trying to predict the price, the goal of the reverse DCF is to quantify the precise future performance that the known stock price is demanding, What level of success, what margin expansion, what growth must happen to justify this current valuation?
Exactly. And this completely transforms the analyst's identity. The traditional analyst is the fortune teller, and they're burdened by all sorts of forecasting bias.
Right.
The reverse DCF analyst becomes the critic or the realist. They are intellectually freed from that impossible task of answering what will growth be, and can instead focus on the strategically potent and testable question. Is the market's implied growth rate plausible? Or is it absurd?
That framing just feels so much more robust. It feels more intellectually honest. Instead of me defending my 5-year forecast against the entire world, I am using the market's own quantified expectation as the foundation of my critique.
It provides so much clarity. You're no longer arguing about whether your WACC assumption is fair. You're arguing about whether a company can plausibly grow its revenue at 40% for the next 15 years. That's a fundamentally stronger, easier, and much more data-driven argument to make.
Okay, let's walk through the mechanics, because while the concept is a mirror image, the execution is, well, it's inverted. Step 1 is simply to start with the knowns.
The ultimate known is the current market share price. It's an objective, observable fact. You use that price to calculate the current market capitalization, and that figure becomes your fixed target value. It's the desired output of your DCF model.
Okay, step 2. We still have to set some of those less controversial assumptions from the original DCF. We can't escape the math entirely.
No, you can't. You still need to set the WACC, and you still need to assume a long-term terminal growth rate, G. We just treat these variables as fixed constants for this particular exercise.
So you lock them down.
You lock them down. And crucially, you might choose a conservative WACC, and a moderate G may be tied to expected global GDP growth to establish a reasonable floor for what the market must be expecting. Even though these inputs are subjective, the point is to isolate the most sensitive variable, which is growth, by holding the others steady.
And step 3 is the magic trick, where we solve for the unknown, the implied growth. This is where the power of inversion is really unleashed, often using iterative tools like GoalSeek in Excel.
Right. You basically tell the model, find the growth rate assumption that makes the calculated intrinsic value exactly equal the current market price. And you're usually solving for the implied revenue growth rate or the FCF growth rate over that explicit forecast period. This rate is the market's current prediction, but now it's quantified.
The sources also brought up the sophistication of the growth appreciation period, or GAP. Now, this sounds like a much more useful metric than just a single percentage rate.
The GAP metric is, I think, superior for communication and for plausibility testing. Instead of solving for some abstract rate of growth, you solve for how many years of a predetermined high growth rate are required to justify the current price.
Can you give an example?
Sure. So instead of the model spitting out the market expects 20% CAGR, you might frame it as, to justify this price, the market expects the company to grow at 20% for 15 straight years.
Why is that better? It gives you a much clearer mental image.
Exactly. People, including professionals, struggle to visualize the power of compounding percentages over long periods of time. It's not intuitive, but everyone can relate to time. Saying 15 years of rapid growth forces you to think historically. Who has actually sustained 15 years of rapid growth? Amazon, Microsoft in the 90s. The GAP creates this tangible timeline that you can test against historical precedents and competitive reality. It's a very powerful visualization tool.
And then step 4 is the critical interpretation, the plausibility test. The output isn't a buy or sell recommendation. It's a diagnosis of the market's belief.
It is. If the implied growth rate, or that required GAP timeline, is historically unprecedented or simply impossible, given the company's size, its competition, and macroeconomic constraints, well, the conclusion is clear. The stock is overvalued.
The market is demanding a future that simply cannot be delivered.
Exactly. And conversely, if the implied growth is ridiculously low-like, the market expects a great company to completely stagnate, and you believe, based on your own fundamental work, that management can easily achieve moderate growth, then the stock is probably undervalued.
What I love about this is that the reverse DCF essentially quantifies market emotion. Our sources called it a touchstone for absurdity.
It is.
It provides these analytically clear guardrails.
It gives you the magnitude of the optimism or the pessimism that's embedded in the price. For instance, if a mid-cap company's price implies that it must grow at 30% for 12 years, you instantly know the market is treating it as a once-in-a-generation phenomenon.
It forces you to scrutinize the story behind the stock.
It does, and this is absolutely vital for those volatile, high-growth story stocks where rational, long-term forecasting is, well, it's an exercise in futility anyway.
So instead of me trying to justify my own $100 price target, The reverse DCF allows me to state with analytic certainty. The market, by trading at this price, is assuming X level of performance for Y years.
And that leads to the only logical debate worth having. Do we believe X growth for Y years is remotely plausible? If X is the sustained growth rate of Apple during its peak iPhone cycle, and Y is 2 decades, the answer is usually a quick and powerful no.
The analysis shifts from a subjective opinion battle to an objective plausibility test.
Exactly.
Okay, let's really nail down the differences here. The distinctions between these methodologies are not just about procedural stats. They represent entirely different cognitive approaches to valuation.
For sure. Let's start with the inputs versus the outputs.
Right.
The traditional DCF takes your subjective inputs, your assumed FCF growth, your assumed WACC, your assumed terminal rate, and it produces a calculated, objective-looking output, which is the intrinsic value or the price target.
And the reverse DCF completely inverts that flow. It takes the objective input, the known market price, and it produces the quantified subjective output, which is the implied FCF growth rate, or that growth appreciation period.
And by making the highly subjective growth rate the output rather than the input, the reverse DCF automatically directs the analyst's focus to the single most important driver of value,
Which is expectations for future growth.
Exactly.
Okay, so that's inputs versus outputs.
Right.
What about the role of the analyst? We've touched on this, but let's reinforce it.
In the traditional DCF, the analyst is the forecaster. Their job is to predict the unpredictable, and they are vulnerable to all sorts of bias, whether it's their own internal optimism or external pressure from management or clients to hit a certain number. Their model is inherently biased because it starts with a belief about the future.
Whereas the reverse DCF analyst is the critic or the realist.
Yes. And the model is, as one source put it, unbiased by design, because it's only quantifying the prediction of the collective market. The analyst's task is fundamentally one of judgment and scrutiny, not prediction.
They critique reality rather than trying to construct it.
Beautifully put.
So this leads to their primary use cases. While the reverse DCF seems superior for critiquing public markets, the traditional DCF still has some critical, non-negotiable uses.
It's indispensable when a reliable market price simply does not exist.
So that means we still use the traditional DCF for internal projects, what finance pros call capital budgeting. Evaluating whether the new factory or a new product line is a good investment for the firm.
Absolutely. You use it when you're valuing private companies, especially for mergers and acquisitions, or when you're trying to establish the initial value for an IPO. In those cases, you must start from first principles because there's no public market anchor or collective sentiment to invert.
The rigor of the traditional model forces you to do that necessary deep dive into the business fundamentals.
It does.
But once that company is publicly traded, and especially if it's volatile, the reverse DCF becomes the ultimate strategic tool.
Oh, it's far superior for analyzing public high-growth or volatile stocks where forecasts are just unreliable.
It's the best way to test and quantify market sentiment. And crucially, it serves as the necessary sanity check to challenge the potentially biased conclusions of a traditional DCF that you might have inherited from a client or seen in a research report.
It instantly shines a light on whether the underlying growth expectations are just heroic or if they've crossed the line into being absurd.
Precisely.
To make this analytical difference really concrete, let's dive into the fantastic parallel example that was provided in our sources, the valuation of NVIDIA, NVDA. A classic high-growth, highly volatile stock driven by massive narratives like the AI revolution.
A perfect case study for this. So in scenario A, the analyst takes a fundamentally rigorous approach, find the intrinsic value, and generate a concrete target price.
This is the analyst acting as the forecaster. They're aiming for an objective answer. Right. They employed standard modeling, extensive FCF projection, a careful calculation of the WACC, which in this specific case study was assumed to be a relatively high 11.3%.
And a conservative terminal value, using a long-term terminal growth rate, or G, of 3.5%.
And you should note the emphasis on those conservative inputs. The analyst is trying to be diligent. They're anchoring G near long-term expected GDP growth. They're using an appropriately high discount rate for a tech company.
They're trying to build a fundamentally sound conservative anchor value.
They are. After discounting all those projected cash flows back to the present, they arrive at their number.
And the result of this rigorous, textbook-adhering approach was an implied intrinsic share price of $133.73.
Right. So based on this $133.73 calculation, the conclusion from the traditional analysis was that the stock was overvalued because the market price at the time was trading significantly higher than this conservative estimate.
But as soon as the analyst delivers that verdict, the criticism starts. Wait, why is that conclusion inherently weak? I mean, they performed a rigorous analysis.
Yeah.
Isn't a fundamentally grounded model strong by definition?
It's weak because it's so easily challenged by the very subjectivity we talked about earlier. The second the analyst presents $133.73 as the true value, a dissenting portfolio manager can just come back and say, your 3.5% terminal growth is way too low. You don't understand the AI total addressable market. It should be 5%.
And the moment that terminal growth rate changes, the value skyrockets.
It skyrockets, and the entire $133.73 analysis is completely neutralized. The analyst is immediately forced onto the defensive, arguing for their own subjective inputs rather than the resulting valuation.
It becomes a battle of opinions again.
It's a contest of persuasion, not analysis.
Okay, now let's shift to scenario B, the reverse DCF. We anchor the model to the objective, known market price, which at the time of this specific analysis was around $117.59.
Right. And the objective now is totally different. It's to quantify the exact level of optimism that's embedded in that price, given the intense narrative around AI.
The analyst holds the WACC and terminal rate constant and inverts the math to solve for growth. And the results from this analysis are, well, they're truly extraordinary. They serve as the ultimate touchstone for absurdity.
They really do.
To justify that price of $117.59, the market was implicitly assuming a growth trajectory that is just historically rare. First, an implied revenue KISS compound annual growth rate of a staggering 47%.
47%. Just pause and think about the size and scale of NVIDIA already. For a company of that scale to grow its revenues at 47% compounded annually, it would require a continuous, near-monopolistic ability to capture every adjacent market, maintain massive R&D spending, and face basically zero effective competition for a generation.
It's a heroic assumption.
Yep.
And second, the analysis solved for the growth appreciation period, GAP, showing the required duration for this growth. The implied GAP was 18 years.
18 years of 47% growth. That is nearly 2 decades of continuous hypergrowth. That would match the best 18-year run of almost any company in modern history, including peak Amazon or peak Google.
So the market, just by trading at that price, is mathematically demanding that NVIDIA sustain that level of world-beating performance until the 2040s.
It's baked into the price.
And this leads directly to the plausibility test that makes the argument so undeniable. The expert sources actually calculated the logical conclusion of that 18-year, 47% growth path. What did they find?
They found that it would result in NVDA earning more revenue than major existing industrial and retail players like Macy's, AutoZone, and Chewy combined.
Wow.
This output provides tangible, undeniable context. It forces you to ask the question, does any rational investor truly believe NVIDIA can achieve a scale and growth rate that fundamentally rewrites the rules of industrial economics for 2 straight decades?
This synthesis is where the strategic power of the inversion becomes so crystal clear. If the traditional DCF analyst says, sell NVIDIA, my $133 model says it's overvalued.
The debate dies. It immediately devolves into a subjective argument about that 3.5% terminal growth rate.
But the reverse DCF analyst completely shifts the burden of proof onto the market. They can walk into the room and say, look, we don't have to argue about my model. We only have to argue about this one fact.
The current price demands 47% growth for 18 years, resulting in a revenue base that is physically, historically, and economically implausible for a company of this scale. Now, is that a scenario you are willing to bet your capital on?
That reframes the debate from a subjective model flaw to a powerful, objective challenge of market expectations. It is an infinitely more persuasive argument when you're challenging these powerful, emotionally charged market narratives.
It removes the analyst's bias, and it removes their guesswork from the equation. The discussion is no longer about the analyst's personal prediction. It's about the market's extreme, but now quantified expectation.
Okay, we've established the overwhelming strategic advantage of the reverse DCF for public market investing. But as you reminded us earlier, no model is perfect. We have to scrutinize its limitations.
We do. And the first limitation is foundational. The reverse DCF is still, structurally, a DCF model, which means it inherits the sensitivity of its fixed inputs.
So the implied growth rate that we calculate is still heavily dependent and extremely sensitive to the subjective inputs the analyst sets for the WACC and the terminal growth rate, G.
Absolutely. If an analyst intentionally uses an unrealistically low WACC, say 7%, for a highly risky tech company, they're already manipulating the result before they even start.
How does that work?
A lower WACC artificially inflates the present value of future cash flows, which means the model will require a much lower implied growth rate to match the current market price.
So it makes the stock look deceptively cheap. or the growth rate deceptively plausible.
Exactly. The subjectivity isn't eliminated, it's just shifted over to the WACC and G assumptions. The analyst still needs rigorous discipline in setting those constants.
Okay. And secondly, the model relies fundamentally on an assumption of market rationality, even if that rationality is, wildly optimistic.
Yes. It assumes that the high price is, at its core, reflective of some underlying future fundamental expectation, even if that expectation is absurd. The model struggles when a price is driven purely by non-fundamental factors.
Like pure momentum or social media memes.
Or panic buying. For highly volatile, non-fundamental events, like some of the spikes we've seen in market history, the price isn't reflective of future cash flow expectations at all. It's just pure gambling sentiment.
So in those extreme cases,
the reverse DCF output is still mathematically correct, but it fails to capture the true underlying driver of the price movement.
And lastly, its purpose is not prediction. So we must remember it's not a better forecaster. It's a critic. And by its very nature, it requires a market price.
Which makes it useless for those traditional DCF core functions like valuing a private company or pricing an IPO.
So we have to be clear. The traditional DCF forces us to understand the business dynamics. The reverse DCF forces us to understand the market dynamics.
They are complementary, not competing tools.
Given those complementary strengths and weaknesses, the expert recommendation is to use both models in sequence to build a truly robust valuation framework.
Yes. Step one should always be to anchor in fundamentals with the traditional DCF. You have to force yourself to do the rigorous bottom-up work first. That exercise of forecasting margins and capital needs, it provides an essential, deep understanding of the business drivers.
And that process gives you your conservative, defensible, fundamental anchor. Let's call that price X.
Right. Then, step two, test market sentiment using the reverse DCF. You immediately invert that same model using the current market price, price Y, and you solve for the implied growth rate and the GAP. This quantifies the market's prediction.
And step three is the most powerful part for making the investment decision. Analyze the expectations gap.
The entire investment decision lies in the gap between your conservative, fundamental anchor, X, and the market's implied, potentially extreme expectation, Y. This gap is the very core of what people call expectations investing.
So if your conservative anchor, price X, is close to the market's price Y, it means market expectations are pretty low.
Right. And that could signal an opportunity if you think the company can even marginally exceed those low expectations.
But if, like in the NVIDIA case, the market price Y is radically far above your fundamental anchor price X, and the implied growth rate is historically impossible,
then you have a clear, analytically defensible signal that the market has fundamentally mispriced the stock based on unrealistic hope. The reverse DCF gave you the yardstick to measure that hope.
And thinking about measuring that market temperature, we should note that this kind of expectations analysis is really closely aligned with broader market monitoring tools. For those of you tracking that overall market fever or pessimism, we highly recommend checking out the iOS app Buffett Indicator on the Apple App Store.
That's a great point.
It provides a daily snapshot of where the overall market valuation stands relative to historical norms, which is another crucial measure of expectation and potential absurdity. Knowing the implied growth rate of a specific stock and then comparing that to the overall market temperature, it just gives you unparalleled context.
It really does.
So let's bring it all together. The final judgment, forecaster versus critic.
Ultimately, the distinction between these two models really does come down to the identity of the analyst.
The traditional DCF is the indispensable tool of the forecaster. Its primary value is in the rigorous process of having to defend every single assumption for an asset, like a private company, that has no observable public price.
But the reverse DCF, that is the essential tool of the critic. It is the reality check that transforms the entire investment debate. It shifts the argument from an untestable subjective prediction into a simple, testable question of plausibility. It forces honesty.
A truly successful expert analyst in today's environment has to possess the fundamental rigor and the foundational understanding of the forecaster. But they have to couple that with the skeptical discipline and the reality testing framework of the critic. You really need both to navigate the sometimes absurd expectations that get priced into modern volatile markets.
Absolutely. You need both hats.
We started this deep dive seeking an objective intrinsic value. But what we discovered, I think, is that understanding and quantifying market expectations, the output of the reverse DCF, is often the more powerful and actionable analytical tool, especially for public equity investors.
It really is.
The reverse DCF forces us to ask that critical, self-aware question. What do I have to believe for this current market price to be right?
And that is the key takeaway for you, the listener. Valuation isn't about finding the single perfect number. It's an exercise in understanding and testing inputs and assumptions, both the subjective inputs you have to defend in a traditional model and the quantified, often heroic expectations the market has already priced in.
Right. And just before we wrap up, a quick disclaimer.
Of course. All the analysis we've discussed is based on publicly available sources, and it may be subject to revisions or differing interpretations.
And this content is for educational purposes only. It absolutely does not constitute investment advice.
Please, always conduct your own due diligence before making any investment decisions.
And if you find these topics interesting and want to hear more of our deep dives or access more advanced content, you're welcome to join our Deep Value Club membership.
Or just subscribe to us on the Apple or Spotify podcasts channel, Deep Value Investing.
The reverse DCF really shines the brightest light on those high-flying story stocks. If you look at a company today, and the analysis implies a growth rate and a duration that matches the greatest 15-year period of Amazon, Google, and Apple combined, you're forced to ask, what specific historical and competitive evidence do I need to believe that such a sustained, history-defying performance is truly possible, let alone sustainable for 2 decades?
And that leads to the final provocative thought, which is this. We know that financial markets are inherently prone to these dramatic swings between exuberance and pessimism. The reverse DCF provides the ultimate objective yardstick to measure that emotional temperature against the cold, hard math of cash flows.
So it's not about the target price.
No, finding the absolute limit of plausibility for a company's price is often far more valuable than trying to pinpoint a specific target price. Go use that tool. Use it to challenge the narratives you hear every single day.